Glencore's shares surged nearly 10% on January 9, 2026, after news broke that merger talks with Rio Tinto had reignited, potentially creating a mining behemoth valued at approximately $260 billion. This development has prompted intense speculation about the implications for global supplies of critical metals and how markets are digesting the prospect of such a transformative deal. What does this mean for the mining landscape, and how will it shape the future of commodities essential to the energy transition? Let's break down the numbers and nuances. Welcome back, strategists. This is the Resource Equation, your briefing room where data, capital, and strategy intersect. If you're new here, subscribe for weekly deep dives into the forces genuinely moving markets and shaping the resource sector's future. Rio Tinto and Glencore, two of the world's largest and most influential mining companies, confirmed on January 9th that they are engaged in preliminary discussions about a potential combination of some or all of their businesses. This latest round of talks follows a previous attempt in late 2024 that ultimately collapsed due to disagreements over valuation and the future of Glencore's coal assets. Should this merger materialize, it would create the largest mining company in history, with a combined market capitalization estimated at over $260 billion. The current framework under consideration involves an all-share acquisition, where Rio Tinto would acquire some or all of Glencore via a court-sanctioned scheme of arrangement. Rio Tinto's market capitalization is roughly 210 billion Australian dollars, about $140 billion, while Glencore's stands near 48.5 billion, approximately $65 billion. Combined, the new entity would eclipse Australia's BHP Group, which currently commands a market value near $161 billion, positioning the merged company as the dominant force in global mining. What makes this potential union particularly compelling is the breadth and depth of the combined portfolio. Together, Rio Tinto and Glencore would control vast reserves and production capacities across metals critical to the global energy transition, including copper, lithium, nickel, cobalt, zinc, and iron ore. Copper is especially pivotal. Prices recently soared to a record $13,000 per metric ton, driven by surging demand from artificial intelligence data centers, electric vehicle batteries, and renewable energy infrastructure. Meanwhile, supply is tightening as many of the world's major copper mines approach maturity, creating a supply deficit that industry analysts warn could exceed 10 million metric tons annually by 2040 without significant new discoveries or recycling efforts. Market reactions to the merger news have been telling. Glencore's London-listed shares jumped nearly 10%, reflecting investor optimism about the takeover premium and strategic upside. Conversely, Rio Tinto's shares fell 2.3% in London, and a steeper 6.3% on the Australian exchange, signaling investor concerns about the deal's valuation, execution risks, and the challenges of integrating two large, culturally distinct organizations. This divergence underscores the complexity and uncertainty surrounding the transaction. Beneath the surface, the merger raises thorny issues, particularly regarding coal assets. Glencore's coal division is substantial, but increasingly controversial due to environmental, social, and governance, ESG pressures, and regulatory scrutiny. Glencore's CEO has hinted at the possibility of spinning off coal businesses in a tax-efficient manner, potentially isolating these assets from the merged group to mitigate ESG risks. This move would align with broader industry trends as coal faces declining demand and mounting political headwinds, especially in Western markets. Pause here. Does this strategy around coal make sense to you? Share your thoughts in the comments. This merger discussion unfolds amid a broader wave of consolidation in the mining sector. For example, last September, Anglo American and Canada's Teck Resources agreed to merge in a $66 billion deal focused on copper, aiming to create one of the world's top 5 copper producers. Such moves reflect the sector's recognition that scale and portfolio diversification are vital to securing supply chains and managing long-term risks amid the energy transition. Returning to the coal question, industry analysts observe that the future of these assets within the combined entity remains uncertain. Potential spin-offs or separations are actively being considered, as the merged company seeks to balance growth in clean energy metals with the realities of legacy fossil fuel operations. This balancing act will be critical in securing regulatory approval and satisfying increasingly vocal shareholders focused on sustainability. So, what's driving Rio Tinto and Glencore to resume talks now, after the failed 2024 attempt? One key factor is leadership change. In August 2025, Simon Trott took the helm as Rio Tinto's CEO, succeeding Jakob Stausholm. Trott has prioritized streamlining the company, focusing on three core product groups: iron ore, aluminum, and lithium and copper, and pledged to unlock up to $10 billion by divesting non-core assets. His more merger-friendly stance and strategic refocusing may have paved the way for revisiting large-scale consolidation. Back to the opening question. These talks reflect mounting pressure on mining companies to secure critical metal supplies amid surging demand from AI, electric vehicles, and renewable energy technologies. But investor skepticism remains palpable, fueled by concerns over potential overpayment, integration complexity, and the cultural clash between Glencore's trading-driven, opportunistic approach and Rio Tinto's traditional mining operations. What happens next? Under UK takeover rules, Rio Tinto has until February 5, 2026 to either announce a firm intention to make an offer for Glencore or declare it will not proceed. Until then, the details remain fluid, and regulatory scrutiny is expected to be intense, given the deal's unprecedented scale and its potential to reshape global commodity markets. How do you interpret this potential merger? Which stakeholders stand to gain or lose the most from the creation of such a dominant mining entity? What market signals will you be monitoring as this story unfolds? Drop your insights in the comments below. And if you found this analysis valuable, don't forget to like and share. There's a twist worth noting. While this mega merger centers on controlling metals like copper and nickel, another looming challenge is unfolding in the battery metals sector, particularly lithium. Supply constraints for lithium, essential for EV batteries, threaten to spark what some analysts call the driest EV crisis yet. As Rio Tinto and Glencore negotiate their future, the race to secure lithium resources is intensifying, underscoring that this deal is only one piece of a much larger puzzle. Subscribe to the Resource Equation for weekly, data-driven breakdowns like this. Up next, how shifting geopolitical tensions are reshaping rare earth element markets and what that means for global supply chains. See you in the next briefing. Quick reminder. This video reports and explains publicly available information and does not constitute investment advice.